Hello and welcome to the Q3 market update. The theme for this market update will be the Summer Olympics in Paris this year. Hard to believe, but the Olympics are actually starting in a couple of days on the 26th. So we're theming it after the Olympics and the various different sports of the Olympics. Some you may know, some you may never follow, but nonetheless, it should be a fun theme. Housekeeping item, which I'll also announce at the end for those that are joining us late. We've been with Raymond James for a little over a year now. And there is a disclosure form called the ADV, A as in apple, D as in dog, V as in Victor. That ADV form, you may have already received an email from Jennifer for acknowledging the receipt of that. But we have to do that as a new protocol here on an annual basis and try and get that as electronic as possible. And so if you get something from Jennifer, by all means, please reach out to if you have any questions, but we need to acknowledge that we've received that as well. So without further ado, I'm going to jump into the... I'm getting a notification here that it's not working. All right. Looks like we're good. Okay. Jump into the presentation. So when we talk about the themes here in general, we're going to have a variety of different topics of discussion. My goal here is to get us through a variety of these items at a high or low level in about a 25-minute period of time. So that's my goal. Housekeeping wise, if you have a question, there is a Q&A option in the menu bar. If you'd like to ask a question there. And then by all means, you all know how to get a hold of me. So feel free to reach out at any point in time. Going to talk about current economy, a little bit on the fixed income and equity side of things. Just a brief touch on AI, because we talked about it a lot last time. The difference between the US and the international marketplace. We're going to touch a little bit on politics, again, at a very high level. Not a political conversation by any means. And then we're actually not going to talk too much about asset allocation today, simply because we've talked about that a lot here in the more recent past. So that's the agenda for today. Moving forward. Unprecedented time. So as you may have heard in the past, markets obviously perform, historically speaking, similarly, right? But then there's always that phrase of is this time different? You know, and I would argue that yes, this time is different, whereas every time is different, right? Because we're always going to have different economic indicators, different factors associated with the economy that contribute to the forward-looking view from a marketplace perspective. Just like the Olympics, bunch of unprecedented things here as well. For the first time, the opening ceremony is not held in a stadium. It's actually going to be held, I think, on the water somewhere. And then no real mascot this year. It's a hat, not an animal. The Eiffel Tower is actually going to be incorporated in every one of the medals. Gender equality is a huge priority this year. And then breakdancing is, or breaking as they'll call it, is the only sport making its Olympic debut. So similar to all that, a couple of unprecedented items from an economic perspective as well. Record amount of national debt, both percentage-wise and dollar-wise. Record-setting Fed pause. So from when the Federal Reserve stopped raising rates to the first time that they actually cut rates, this is eventually, if we get through to September, will be the record-setting pause where the Federal Reserve hasn't taken action one direction or another. Record inversion of the yield curve. So where the short-term yield is higher than the long-term yield. And that inversion doesn't last very long. And we'll see that ultimately correct at some point as the Federal Reserve starts changing rates. Because as they start changing rates, the short end of the curve is more affected than the long end of the curve. Longest bond bear market. So back in 2022, bonds got hammered by the rapid rise of interest rates. Now that we're kind of sitting at an all-time high from an interest rates perspective or close to it, and interest rates start coming down, we will see bonds start to perform over time. But for now, still a quote-unquote bear market in the bond industry there. And then a large tech-oriented equity market. So the magma, right? We'll talk a little bit about that as well. From an economic perspective, we'll relate that to the surfing environment. And up until this point, riding the wave of this robust consumer spending since COVID, right? And over time, that's going to start to come to a slow, just like as a wave starts to crest and crash, the momentum of that wave ultimately loses its power. But are we in line for a wipeout or a potential challenge associated with this slowdown? We shall see. As it loses some energy here, obviously post-COVID conditions and related to the current market conditions. Post-COVID, we had an improved labor market, record net worths on paper, record low delinquencies, right? So not a lot of defaults on various different types of debts. Elevated spending on travel. So pent up travel because people couldn't go anywhere in the middle of COVID to just going crazy after COVID. And same with demand. So construction, things like washers and dryers, car purchases, all that stuff, pent up demand as well, pulled that into current spending. Then we relate that to the current conditions, right? We see hiring plans. So on a go-forward basis, the plan to hire is at a 3-year low. The record net worth, albeit still at a high net worth, a record net worth. Those that are in the lower incomes are struggling simply because they're not getting a bunch of interest yield because they don't have a ton of cash in the bank to earn that yield. Subsequent to that, we also see that we have delinquencies at a 12-year high, albeit still very low from a delinquency perspective. Travel spending is at a 6-month low, and we can see that in the airports and things like that, albeit when planes get shut down, airports get pretty crowded. But in general, traveling is at a 6-month low. And then on a go-forward basis, the large purchases, those washers and dryers, cars, et cetera, homes, are at a 4-year low. So some impact to the economic indicators on a go-forward basis. However, our thinking here, if we go back to the beginning of the year in Q1 when we did this presentation, we talked about a GDP of 0 to potentially slightly negative for the year. And that outlook has changed to about a 2% per year outlook for both 2024 and 2025. In addition to that, the anticipation of a Fed rate cut expected in 2024. If you recall, at the beginning of the year, we talked about 6. We were in the camp of 3 to 4. Last update, everybody was in the 3 to 4, and we were in the camp of 2. And now everyone's looking at the expectations around 2 Fed rate cuts starting as early as September, and we're in the camp of 1 to 2. So being slightly conservative in relation to what the market has priced in. The reason why we expect some amount of cut is because we see the impact of a higher interest rate for longer on the inflationary environment. Biggest thing to note here and the difference between these two lines. The light blue line here, this is core CPI. So this includes everything other than energy and food. This number here, right on the lower percentage, excludes shelter. And so why is that important? Well, rents are an all-time high. Home purchases, albeit at an all-time low. The cost or the barrier to home purchase is pretty high given current interest rate environment. And so if we exclude shelter, which is obviously quite a large expenditure, we can see that prices of other things are starting to normalize again in that 2-ish% range. Last but not least, just in general, although GDP is poised to be slower, the anticipation is that it's still positive growth on a go-forward basis, at least for the next year or two. So what does it mean from a Fed cuts and skirting the whole wipeout theme here in the surfing analogy? Essentially, just looking at the biggest thing to look at here is a couple of factors that the Fed are considering. Businesses need a lower interest rate from a functionality perspective. Even if we look at the US debt by the end of this year, it is projected that our payment on our US debt from a government spending perspective is going to outpace our defensive spending by the end of this year. So obviously both the small businesses and the government itself need some interest rates to be a little bit lower. In tandem with that, the short-term maturity over the next 2 years of our US debt, about 43% of that is going to renew. So renewing that at a lower interest rate from a government spending perspective would be pretty advantageous there. So a couple of other items here, but those are the kind of the two big things that I wanted to focus on. Lastly, when we talk about exposed interest rates in sensitive areas, buying a home, right? We're losing a lot of purchasing power with mortgage rates at the 7-ish, 6.5-ish% rate. When, 2 or 3 years ago, we were in the mid to high 2s, right? Low 3s. The impact of that ultimately reduces our purchasing power on being able to go out and buy that same type of home, even at the same purchase price, because our debt is that much more expensive. Luckily, though, especially in this area, most of us have a fixed mortgage back in that 2.75 to 3.25 to 3.5 range, and so the effect on us, assuming we're not changing our home environment, is less of an impact, but certainly impacts things like car purchases, etc. Moving on to fixed income. Let me just see if perfect. Moving on to fixed income. Well, what does that mean from a Federal Reserve perspective? Bonds are set up to be a pretty positive environment. The presentation here is trying to relate it to the volleyball world, but if we move on outside of the relationship to volleyball, look over the next 12 months, fixed income environment is poised to have a pretty positive return, and we'll talk a little bit about what that actually means. There we go. So cycle been like no other in the recent past. So if we look at this chart, what this chart showing is since rate hike to rate cut, how is the interest rate affected between those two positions? And most of the time, the average is anywhere from 0.5 point lower to 1.5 points lower. Currently, our interest rate rose, right? So the last time the Federal raised rates to eventually when they finally cut rates potentially later this year, right now we're at a 0.5% higher than when the last time the Federal Reserve raised rates. We expect that to get closer to the mean of down 0.5% or even neutral here as we get closer to the potential rate cut in September, if that is to happen. Additionally, longest duration for which the yield curve has been inverted. And so what that again means, if we look at the yield curve over time, shorter time commitments, right, of debt should be paying a lower interest rate because there's less risk. Okay. So what that should mean is if I'm going to lend you money for a year, it's less risk to me than if I lend you money for 10 years. Okay. Conversely, your interest rate should, or in tandem with that, your interest rate should reflect. In a current environment, that theory is flipped, where in the short term, you're actually, the interest rate expectation is higher than what it would be in the long run. And that's mostly because as the Federal Reserve changes rates, the shorter end of the curve is impacted greater because the expectation is that eventually those rates will revert back to the mean the longer we get out on the yield curve. So we should see some amount of impact to the inverted yield curve as we correct rates as well. Why are we expecting rates to tip lower? Well, all of the things we've already talked about, but the anticipation of the change in the yield curve happens more again on the shorter end than it does on the long end. And we can see that impact here on the expectation of the 10-year in the dark blue versus the 2-year in the light blue, and the expected average change in yield over the next 12 months. Secondarily to that, as we look forward in the next year, not only do we have a higher yield than we've had historically speaking, if we look back 2 or 3 years ago, fixed income wasn't really paying anything, right? You're not getting any value in the money market account, getting very little to no interest in the bank. Today, you're still getting a little bit of interest in the bank, but kind of nothing still. But if we look at general money market accounts, you're still getting a pretty good yield today. So in relation to the U.S. Treasury yields, right, if we look at a 2-year paying 4.75 or a 10-year paying 4.37, and that's what we're talking about on the inversion there. If we see interest rates tick lower, let's say, we have 2 rate cuts here in the next year, the anticipation is that the total return of a 10-year Treasury currently yielding 4.3 is going to be something more like 8%. And that's simply because as interest rates come down, the value of the bond you hold that was paying a higher interest than a new bond would be today is going to go up, right? Because people want that higher yield. And the market knows that and prices that in. Moving on to the equity markets, we're not going to spend a ton of time here, but in the current year of 2024, as of the end of June, we've notched 31 record highs year to date, and actually it's 35 today. So markets are moving in the positive direction. If we go all the way back to the beginning of 2023, we had a bunch of analysts. Pretty much every analyst was in the camp of flat to negative year. And then we fast forward that into 2024. Fewer were flat to a negative year, but nobody was really super excited about the year. Okay. And if you look at from the beginning of 2023 to today, the S&P 500 is up something like 40%. So the impact of that is pretty great. And so if we start making decisions emotionally, right, on what the analysts are saying, what the news is saying, and we react extremely within our portfolios, we potentially miss out on a lot of that performance from a long-term growth perspective. That's not to say markets don't go down. They certainly do over time, in certain tranches. But for the most part, we see markets continue to rally as companies continue to be profitable, and we want to be able to participate in that. With that being said, we talk about a bull market environment. That's essentially saying how long stocks have been rallying for. The average bull market is about 5.5 years. We're currently in about 1.5 years, just over 1.5 years. And we're actually lower return in the current bull market than this historical average. And so that's us in this red line here. And so what does that mean? That means that there's still some room ahead from a growth perspective, and there's also some room ahead to catch up to the average bull market return as well. Why the bull market can continue? Because we can continue to see earnings outpace. And we'll talk about that here in a second with the tech-heavy market sector. Still some positive economic growth, right? So we're projecting that GDP number to still be fairly positive on a go-forward basis. Record amount of cash on the sideline. So businesses just have tons of cash on the sideline. Individuals have a bunch of cash sitting on the sideline. And that amount is something like $6 trillion sitting on the sideline, just ready to be deployed. And as we see those dollars continue to be deployed, that should push markets positive as well. And then ultimately, as interest rates become lower due to the adjustments of inflation. If we look at the performance thus far year to date, this talks about the Magmin as relates to the rest of the index. Magmin is the Microsoft, Apple, Google, Meta, Facebook, Amazon, and NVIDIA. Year to date, up about 45%. The rest of the index, which is the mega cap tech sector, is only up 4. Okay, and we can even see small cap actually had a little bit of a rally since we made this presentation, but still underperforming as compared to the Magmin. Well, what does this show us? Okay, well, what this shows us is those 6 stocks have really been the tailwind force behind the performance of the market. However, we also expect that this rest of the index should start to revert to the mean, which means that we should expect in Q4 and Q1 of 2024 that the earnings growth should continue to accelerate for the rest of the index. And that's shown here where the dark blue is the Magmin, right? Those 6 stocks. And then the light blue is the rest of the index. So we go back to, as an example, to Q1 of this year, those 6 stocks were literally the only reason why the market was up in that first quarter. And most of the reason in the second quarter. And then as you see, we get into the fourth quarter and then the first quarter of next year, it is projected that the rest of the index is going to start to perform and catch up. All righty. Artificial intelligence, AI, we've talked about this many times at great length and even in our individual conversations many times as well. However, we're going to relate this to breakdancing. Right, and breaking, that's the new add into the Olympics this year. Why is AI such a big deal now, right? Like you go back, we had, our vacuum that goes around our house that doesn't bump into things and does it automatically, back in the early 2000s. We had, people playing chess against robots in the late 90s, right? So all of that is still, artificial intelligence theoretically, right? It's just the explosion of things like ChatGPT and the development of the technology associated with that AI calculation is continuing to advance at a rapid pace. If we look at earnings, the projected earnings of companies on a go-forward basis, earnings continue to outpace the projection of that tech sector. And if that holds true, the anticipation is that the IT sector is going to continue to perform over a period of time. And last but not least, from a tech record amount of cash, right, deploying into the AI sector, into dividends, into stock buyback, right, all bode well for positive stock movement. The tech sector has the most cash by far sitting on the sidelines. International equities, we're going to equate this to the women's basketball, who hasn't lost in seemingly many years at this point. They've won 55 games straight. Similar to the US equity market, outperforming the developed international market by 340%. Yes, that's 340% for the last 16 years. So bottom line here, we have been heavy US-based historically over the last few years, and we're going to continue to lean that way on a go-forward basis, albeit there are some pockets that we still want to participate in, like in emerging markets as an example, because we can see the impact of interest rate changes impact the emerging market space more harder, okay? Let's see here. Just like the U.S. women's national team, 7 Olympic gold medals, 55 games straight of wins, outscored opponents by a whopping 1,583 points since 1996. U.S. equity markets outperformed international 12 of the last 16 years, outperformed the international space, developed international space by over 340%, and earnings growth has outpaced over 180%. So when we talk about, historically speaking, being overweight U.S. equities, it has worked out quite well for most of you and anticipate that on a go-forward basis here as well. Last but not least, we're going to talk about the political environment. Obviously, in the last week or so, last few days, there's been some dramatic changes in this environment. This is not a conversation about parties or any of that stuff. It's just talking about the expectation associated with the marketplace. The rationale around the projections of who's winning the various presidency, Senate, and House. We see the anticipated projection here that Trump winning over Biden. Obviously, Biden is no longer running. The projection for Biden and any other Democrat is that, or any other candidate to replace Biden. The ratio is expected to stay fairly similar. And most of that is attributing to a variety of things in the past. But primarily because Trump is leading in all of the 6 swing states, albeit a couple of those states are by a very slight margin. In the Senate, we anticipate a 75% probability that it's a Republican Senate. And then in the House is actually about a 50-50 split, slightly leaning towards a Democratic House. Why do we care? A lot of people are concerned about investing in a political environment. And the concern around the volatility associated with the political environment. If we look and we see, regardless of whether it was a Democrat or Republican in the presidential seat, historically speaking, all the way back to 1970, and you invested, I think it was 10 grand in 1970, that is projected to be, as a Republican, if you were only invested while a Republican was president, that 10 grand grew to 132K over those last 50 years. If you only invested when a Democrat was a president, that 10K turned into $667,000. And if you were invested fully, regardless of who was president over that time period, that 10 grand turned into $1.53 million. Okay. Why is that important? Let's get away from the drama associated with who potentially might be president and the impact of that presidency in the marketplace, and simply take a higher step, right? A step back to that 50,000-foot view and say, you know what? I still want to participate in companies that are profitable and over a long-term growth perspective, continue to outpace what cash potentially would do in the bank. Staying invested for the long run is ultimately going to work out quite well. And we've seen that historically speaking. 428 did pretty good. What I'm going to do is I'm going to check the Q&A board to see if there's any questions on any of that at this point. I don't see any questions. I know that was like drinking through a fire hose at this point. If you have any questions that you want to answer, that you want answered, and you want to reach out to me directly, happy to have that conversation on a one-on-one basis as well. Other than that, I'm going to end this call at 4:29, 1 minute before my 4:30 deadline. I look forward to the rest of the year here and meeting with all of you here in the next few months. By all means, enjoy the Olympics. It's a wonderful feat to see some tremendous athletes perform at the highest level. Go USA.